reading of the monetary policy statement for the month of February 2026. On 9th February 2026, the Monetary Policy Committee, MPC, of the Bank of Uganda, BOU, maintained the central bank rate, CBR, at 9.75%. The committee assessed that the prevailing policy stance remains appropriate to support economic activity while ensuring that inflation stabilizes around the target over the medium term to long term amid persistent global economic uncertainty. Inflation has remained below the medium-term target of 5%, reflecting the impact of prudent monetary policy, complemented by coordination with fiscal policy, a stable exchange rate, declining global inflation, and favorable food and energy prices. Over the 12 months to January 2026, annual headline inflation averaged 3.5%, while core inflation averaged 3.8%. Headline inflation edged up marginally to 3.2% in January 2026 from the 3.1% in December 2025, reflecting higher inflation in some core components, partly offset by a decline in food crop inflation. Similarly, annual core inflation increased to 3.3% in January 2026 from the 3.1% in December 2025, driven mainly by higher services inflation, particularly in the passenger air transport. Annual food crop inflation moderated to 3% in January 2026 from the 4.4% in December 2025, supported by favorable weather conditions. Energy, fuel, and utilities inflation rose slightly to 1.7% from the 1.4% over the same period due to modest increases in firewood prices. The inflation outlook has been revised slightly downwards relative to the November 2025 forecast round, reflecting the effects of modest exchange rate appreciation and lower international oil and food prices. Inflation is projected to remain slightly below the target in 2026, within the range of 3.8% to 4.3%, before stabilizing around the medium-term target of 5%. This outlook is supported by continued prudent monetary policy, stable exchange rate conditions, and moderating global commodity prices. Risks to the inflation outlook, both upside and downside, remain elevated. Upside risks include stronger than expected domestic demand arising from a positive output gap, where a positive output gap is where the economy operates above its current potential, partly driven by a more expansionary fiscal policy. Additional risks stem from a combination of domestic and external factors, exerting higher than anticipated inflationary pressures, including a persistently depreciated exchange rate, escalating geopolitical tensions that could disrupt global supply chains, and adverse weather conditions that may reduce agricultural output and raise food crop prices. On the downside, risks include a sharper than projected slowdown in domestic economic activity, a deceleration in global growth stemming from trade-related shocks and heightened uncertainty, and a decline in commodity prices with disinflationary effects. Economic activity remained steady during the first 3 quarters of 2025, with an average growth of 6.3%. The growth was largely driven by final consumption expenditures, which expanded by 14.7%, mainly reflecting strong government consumption growth of 22.8% compared to a growth of 14.2% household consumption. Despite the moderation in growth in the 2 quarters to September 2025, High-frequency indicators and forecasts point to a high economic activity in the quarter to December 2025 and in the second half of the financial year 25-26. Economic growth in financial year 2025/26 is projected in the range of 6.5 to 7%. Over the medium term, economic growth is expected to strengthen further, rising to an average of 8%. This outlook is underpinned by accelerated public investment, oil-related and infrastructure developments, government initiatives, continued improvements in economic environment, prudent monetary policy, and increased private sector activity. Notwithstanding the favorable outlook, risks to the growth projections are tilted to the downside. This includes evolving geopolitical tensions, which could dampen global growth, also disrupt the trade routes and supply chains, and exert upward pressure on commodity prices, particularly oil. On the upside, stronger than anticipated investment in extractive sector, a more robust global recovery, and easing trade tensions could result in higher than projected economic growth. The economic environment continues to be characterized by heightened uncertainty, necessitating a cautious monetary policy stand. Against the backdrop of the recent economic developments and balance of risk to inflation and growth, the MPC kept the central bank rate unchanged at 9.75%. The CBR band at plus minus 2 percentage points, with the rediscount rate and the bank rate set at 3 and 4 percentage points above the CBR, respectively, resulting in a rediscount rate of 12.75% and a bank rate of 13.75%. The MPC considered this decision to be consistent with its strategy of guiding inflation towards the target over the medium term, without compromising its primary objective of price stability. The policy stance also supports smoothing economic fluctuations and fostering socio-economic transformation. Future policy decisions will remain data-dependent, informed by continuous assessments of domestic and global risks. Our listeners and viewers, that marks the end of the reading of the monetary policy statement for the month of February 2026.